Good morning, good afternoon, and good evening. Welcome back to the It's Attainable Real Estate Investing Show, episode number 12. We're continuing where we left off last time. Is it a deal or is it not a deal? I'll give you the facts, give you the data, and I'll let you decide.
Welcome to the It's Attainable Real Estate Investing Show, where you will learn about investing, the power of real estate investing, and how to invest in it. Whether you have the time or even if you don't, you're going to see it's attainable either way. And now your host, who always wants to share knowledge with you, Christopher Balkin.
We're going to continue in this show where we finished in the last one. We talked about quite a few things in the last show. Return on investment, or ROI. Simply put, it's the return of the dollars or capital or money that you put into the investment. It could be any investment, but in this show, of course, we're talking about real estate investments mostly. So the return on the dollars or the capital or the money that you put into the investment. So the measure of the dollars you get back for what you put in. It's just that simple. Part of the measurement of that is cash flow. Remember that real estate has multiple income opportunities, which is a good thing. But one of those income opportunities is cash flow, which is made up of income and expenses, or really the difference between the two. The difference between the income and expenses, what's left over, is cash flow. Of the multiple income opportunities of real estate investments, I would say as you look at a deal to decide if it's really a deal, or as you analyze properties to decide if they're really a good investment or not, or if you're a passive investor and you analyze the information that's given to you to decide if you want to invest in it or not, I would say cash flow is a leading indicator that you should look at. Cash flow is going to show you that month to month, year to year, does the income cover all the expenses? Because if it doesn't, you might be investing in a bill, and we're not investing to acquire another bill or another liability. We're looking for a return or money back for the money that we put into the investment. So cash flow, really important. The difference between income and expenses. What's left over goes to the investors. In the last show, we talked about the trailing 12 months profit loss statement. So that is the breakdown of the income and the expenses for the property. So we said that cash flow, the difference between income and expenses is cash flow. Well, you need to know what the income and expenses are for the property. So the trailing 12 months profit loss statement, or 24 or 36 months if you can get it or if it's available. This will show you historically what the income and expenses of the property look like, or what the income and expenses of the investment look like. Very important in determining, is it a deal or is it not a deal? Now, as we move down to rent roll, this is going to break down or identify the leading source of income for real estate. It's the rent. Now remember, rent in real estate can be income from tenants in an apartment building, tenants in a restaurant if it's maybe a complex or some type of commercial building. It can be rent from an industrial company if it's like an industrial park or industrial type of complex or building. Stores if it's a shopping mall. Real estate encompasses all these things. So the rent roll is going to break down the tenants, the list of the tenants, what they pay, when their lease started, when their lease ended, etc. In the last show, you'll remember that we looked at an actual profit loss statement from an opportunity that I was analyzing. Then we looked at a rent roll as well. In this show, we're going to look at what to do with that information. Now that you have the data, you've analyzed it, you've got your questions answered from the seller or from the person who is marketing the property for sale, what do you do with it? Well, enter into the deal analyzer. So I've talked about the real estate investment having an income side and an expense side. And we said what's left over income minus expenses equals cash flow, which is an important part of your return on investment. So you need to be able to accurately identify and document the rent, which is the majority of the income for real estate investments, and then the long list or laundry list of expenses. The deal analyzer allows you to do just that. So I called it the deal analyzer, or enter into the deal analyzer. We'll say it's a deal analyzer. This is a document or a spreadsheet or analyzer that we created for our purposes. And you would probably do the same. You could reuse something like this. We could provide it to you to utilize for analyzing your own investments, whether actively if you're going to be looking for and identifying and managing the opportunity, or if you're going to be passive and you're just going to invest in an opportunity that might be presented to you. In either event, this analyzer can assist you. So let's dig into it a bit. I've put some color codes here to kind of help us along. Green is good, of course. Actually, none of these indicators are bad, but green is kind of related to dollars, and at least in the U.S., currency, paper currency is green, so I related it to green for income. And then we've got yellow, which is just an important indicator of information we need to enter for the mortgage, if there's going to be a mortgage on the property. Then we've got orange. And again, none of these color codes are bad. It's just we've got orange, meaning we need to stop and we need to enter our expenses. And then we've got cash flow, again, relating to the currency, at least in the U.S., being green. So cash flow meaning what you have left over, again, after income and expenses. So as we look at this, we'll start with rent. We set rent as the leading income stream for real estate investments. It's where most of the income comes from. There'll be other things, such as in the example of a multifamily apartment building or single family home or some type of residential real estate investment. You may have other income like coin laundry if there's something like that available, or payment for amenities such as garages or carports, or things like pet rent if the investment of the property is going to allow pets, things of that nature. But majority, by and far, rent is going to be the leading income stream. Again, whether residential, industrial, commercial, retail stores, restaurants, someone or some company is still going to pay rent. In the example here, we show this is a monthly number here on the left, and then an annual number here on the right. So in this case, we're going to say the monthly rent for this particular property. Let's say this was a 10-unit apartment building. We're just going to type the number 10 here. So let's just say this was a 10-unit apartment building. We'll keep these numbers round. I've entered round numbers here to keep the math simple and easy to follow for even those that are not in front of a computer or calculator. So $10,000 monthly in rent times 12 months in a year equals $120,000. Again, monthly on the left, annual numbers here on the right. Monthly and annual rent. That's simple enough to follow, right? Okay, vacancy, or economic vacancy rate would probably be the official term for it. This is the loss of income or the loss of rents due to units or apartment homes, or again, if it's a restaurant or a plaza or shopping mall where there's vacancy. So the units or the stores or whatever amount of space that you're leasing or renting, this is loss of rent due to that space being vacant. This example, again, is a 10-unit apartment building, we're going to say. And vacancy, at least in this region, the region of where this example apartment building, this 10-unit apartment building is, the economic vacancy pre-COVID-19, so before COVID-19 came upon us, was approximately 5%. So that means that 5% loss of income due to the units or the space or whatever you're leasing being vacant. I'm going to type in 5% here just to remind us of what this number is. Again, monthly number on the left, annual number on the right. So 5% of $120,000 in a year is $6,000. So that means a 5% loss that we should at least plan for. This is the general number, at least for this region, and it's going to be different in each region, but in this region, it's approximately 5%. So where would you get that number from? Vacancy, the economic vacancy rate. So you could ask a real estate broker or agent. They should be intimately aware of what the economic vacancy is. And it's going to vary from region to region again, but also class of asset also. So the vacancy of a industrial park or a restaurant or a multifamily apartment building, those things may all have different vacancy rates. A local real estate broker or local real estate agent should have this information. So it's 5%, and that's what we've got entered here. I'll stop here to say that this obviously is an Excel spreadsheet, Microsoft Excel. You don't need to be a master or an advanced Excel user. Again, we talked about in past shows that the math behind real estate investing is not complex. It's mostly adding, subtracting, multiplication, division, a little bit of algebra, trying to solve for maybe a variable, or which is usually when you're trying to plan out something in the future. But it's the same in Excel. So the most complex formulas are going to be adding, subtracting, multiplication, division. We've got, a little bit of fancy things we'll get into here where we can figure out the mortgage rate or the monthly mortgage when we enter the purchase price. But those things are well documented and pre-built into Excel. So don't have to be an Excel advanced user, but if you do know something about Excel, it does help because you can click on the cell and be able to kind of understand what's taking place. Just for example here, if we double click, we can see that cell D5, which is $120,000 above, times 0.05, which is 5%. That gives us the $6,000. So that's kind of what's going on here. And if you know something about Excel, you'll at least be able to kind of back into the math so that you can do this with or without Excel. But certainly having a spreadsheet allows you to accurately document the information and be able to make adjustments in the future. Economic vacancy rate is just one factor here in this entire analyzer, but it is important because you're bound to have vacancy. No matter what the real estate asset class, again, whether it's commercial, industrial, restaurant, stores, apartment buildings, people or companies don't stay forever. Things change in life for people. Things change economically or strategically for organizations or companies. So there's bound to be some vacancy from the time that someone moves out to the time that the next person or the next organization or company moves in. I don't want to spend a lot of time on it because I said it's just one factor, but let's just, using this multifamily apartment building example, let's just say that as shown here, these apartments, there's 10 of them, 10 times $1,000 equals $10,000 as shown here on the monthly rent on the left. So let's just say that an apartment was vacant for 2 weeks. Let's just say 18 days. You target to turn around a vacancy as quickly as possible. So again, whether it's commercial, industrial, apartments, the longer that a unit or space is vacant, the less income there is coming in. So whoever's managing the real estate investment or the property managers that may be managing the property, one of their chief goals is to reduce turnover time as low as possible. So let's just say there was one apartment. It was vacant for 2 weeks. We'll say 18 days. So instead of 14 days, we'll add a few days after that. So apartment was vacant for 18 days. So we're going to keep that in our memory here. And let's just figure out what rent is per day. So we're going to take 1,000. And we're going to multiply that times 12. So $12,000 would be what that tenant or organization or company would pay in rent for an entire year. We know that there are 365 days in a year. So that gives us $32.88 approximately there for rent per day. So let's take that and we're going to multiply that times 18 days of vacancy. So $591.78 is what is lost, or what someone would have paid if they had have been present there, or what the company or organization would have paid had they been leasing the space. But since it was vacant for 18 days between when someone moved out and someone moved in, this is what is at risk or possibly lost during that time. So we're going to divide that by what they potentially could have paid, which was the entire year. And we've got an economic vacancy rate of about 5%, so 4.93%. So just an example here, how we arrive and how the vacancy rate is calculated. Okay, so moving right along. So we've got monthly rent, we've got vacancy rate, and then we've got total income. And the total income will be what's left over after we factor in that vacancy rate. Now maybe time goes by, maybe a whole year goes by. It may not be uncommon for multiple units. Maybe if you had a single family home or a small apartment building or a store you owned, I guess it wouldn't be uncommon to not have any vacancy for a year. But typically there's going to be some vacancy once you get over that year's time. But let's just say maybe you didn't have any vacancy. So your entire income would be the $120,000. But we still want to factor it in here just in case. So with it factored in, that leaves the income for the investment at $114,000. So kind of the modified gross income. $120,000 minus $6,000 economic vacancy rate equals a modified gross income, we'll call it, of $114,000. Okay, that's enough of that. Income is important because that's how we start the investment is with the income, and then we minus the expenses, and what's left over is part of your return on your investment. But moving along here to the yellow section. So here we have the mortgage, or what's going to make up the mortgage, and what's going to make up the investment altogether. So we've got an asking price here, and this is just showing you the analyzer. This is just free text. There's no calculations behind these numbers specifically. You're going to type in what the asking price is, what the current value is of the property, and what you estimate the future value of the property will be. So where do you get these numbers? Well, asking price, this is, I'll say obviously, it may not be, but this is, we'll say more so obviously what the person who's selling the property or what their agent or person on their behalf of the seller is selling the property for or marketing the property for. So in this example, the person wants to sell the property for $500,000 or $500,000. We'll say in this example that the current value is also $500,000. So how do you know what the current value is? We're going to continue to talk about valuing in future shows. It's not very difficult to figure out, but it deserves probably a show of its own. But in this case, we'll say the current value. Let's just say that it is the asking price. Let's say it matches. You probably could ask the agent, your own agent, if you have a real estate agent working on your behalf as the buyer. You probably could ask what the value is. Agents have access to determine based on metrics or known electronic information or known data about a property, such as square feet and the rents and different factors around a property. They can find out an approximate price. They can do a competitive market analysis to determine the approximate value of an asset. And there's more that goes into that. For those of you that already invest, you're probably yelling out terms like he's forgetting about this and that and the other. I'm not forgetting about it. There's things like the cap rate and other things that we're going to talk about, which, like I said, deserves a show all on its own, and we'll get there. But the current value for this example, we're just going to say that the current value is equal to the asking price. We'll say that they're right on with their asking price. They want to get the most out of that property. So future value, how do we know what the future value of the asset of the property is going to be? So we've got $600,000 entered. How do we know that it's going to be worth that tomorrow or next week or next year, 5 years, 10 years from now? So in episode 5, I think it was, we talked about 2 ways that real estate can increase, natural appreciation and forced appreciation. So typically real estate will increase kind of alongside inflation at approximately, we'll say 2 to 3% on average. It's going to vary in some regions. Some regions are growing greatly ahead of leaps and bounds ahead of other regions. But for this example, we're going to say that real estate increases 2 to 3% per year on average. Similarly, rents, rental income from the assets will increase along that rate too. Now, I know some regions that are growing heavily will increase well beyond that, but for this example, we're going to say approximately 2 to 3%. And in terms of valuing in general, I say again, we're going to have a show specifically on valuing. So that's natural appreciation, just the property going up just based on maybe some supply and demand, maybe just the economy, some of the things around it. Forced appreciation are things we can do to the business or to the property to increase that value. So increasing income, finding a way to increase more income, finding a way to decrease expenses, that's going to help or aid in increasing the value of the property. Because as income increases or expenses decrease, we remember that that's the equation for cash flow. So income minus expenses equals the cash flow, and as the cash flow increases, that will weigh heavily or be a direct effect on the value of most properties. So $600,000 it is, at least for this example. A loan to value. So 75% LTV, LTV meaning loan to value. So when it comes to acquiring a mortgage on a real estate asset, a bank will typically not, or bank or lender will typically not give you the entire purchase price. They usually require some type of what we call skin in the game, something to lower their risk, something to align interests, at least some. So on a $500,000, $500,000 purchase, we show the down payment here as 25%. So a bank or lender is going to usually require 20 to 30% is what I've seen, for example. Now, maybe your relationship with the bank or a lender or the asset itself will determine what the bank will require, but 20 to 30% is what you can expect in terms of down payment typically. So for a $500,000 purchase, the bank is going to pick up 75% of that, and you, the investor or investors, will need to come up with the other 25%. So the difference of that is $375,000 that the bank will provide and $125,000 that you, the investor or investors, will need to bring to closing. As we look at all-in investment, like what does that mean? It looks like here it's equal to the asking price is equal to the current value. All-in investment here means there could be things in addition to just the purchase of the property that may be a part of the mortgage. So what does that mean? Like what else could there be? I'm going to buy the asset or the real estate and that's it. Well, what if you needed to or you wanted to do some repairs or some renovations or some improvements to the property? That's typically where the all-in investment comes from. So we've got the purchase price of the property or the asking price, $500,000. Maybe there's $50,000 in renovations or improvements. Maybe this will be part of forced appreciation, and as you put this $50,000 into the property to renovate it, maybe that increases the rent. Or maybe that does something with the expenses. Maybe replace some things that were continuously consuming more energy or needing multiple repairs, and we're able to decrease expenses. But for the most part, some of these improvements will either save energy in terms of expense savings, but more likely going to increase the income stream. So that would be forced appreciation. That's what would allow you to force the value of the property to be worth more in the future than it is the day that you purchase it. But this all-in investment or these additional things beyond the purchase price could be anything, but ideally it's something to do with the property. So renovations, improvements, again, etc. So the interest rate, this is an interest rate just like anything else when you get a loan from a bank or lender. This is their profit or part of it may be their profit on the investment they're really doing with you. Essentially, the bank is investing their dollars or the dollars of their members or customers in you or in your project or in your real estate investment. So this 4.5% here shown as an example is payment to the bank. So this is interest. All of this may be the bank's profit or maybe just some of it, but anyhow, it doesn't matter. It's just 4.5%. That's what the bank charges. That's what goes into the equation, or that's what makes up the mortgage. So going down here, we've got 25%, 75% loan to value, 25% down payment. Together, that equals 100%. So we could change this. Like I said, it could be 20%. That lowers the down payment. Obviously, it could be 30% you need to bring to closing. That increases the down payment. And we can see 70 and 30, the formula here changes as we enter our information. We're going to go back to 25% just for this example. And now the term. So this is measured in months here. I probably should type out here. We use this all the time, so we know what this is, but in showing or sharing it with others, I should put in term in terms of months. So this would be a 25-year mortgage. 360 would be a 30-year mortgage, for example. So we're showing here 300 months or 25 years. So that's the amortization. So the mortgage or the loan to value here that the bank is providing, the payments will be calculated based on 25 years. And what does that give you? So if we factor all this together, we've got our loan to value, $412,500. That's the part that the bank is going to put up towards your investment or this investment, this real estate asset, this purchase, based on 4.5% and 300 months or 25 years. The monthly mortgage payment is $2,307.47. This takes us into our expenses. So I'm showing the principal and interest here as part of the expense because I'm trying to calculate cash flow. And cash flow is every check or every dollar that goes out the door, what's left over, again, you know the formula now, is cash flow. Now, as we value the property, and some of you maybe who do real estate investing today may be saying that, oh, principal and interest and debt does not go into valuing a property. And that's true. And valuing is going to be a show all on its own. But for the sake of understanding cash flow, principal and interest, you need to write a check for that each month to the bank. If you want to keep the property or keep the real estate asset, we're going to leave it here as an expense. Now, as you look at this number, you may be saying, wow, Chris, this $2,307 a month or this $27,000 a year, this is a whole lot more. This is a big number in comparison to the rest of the expenses in this list or this category of expenses. This is a lot in comparison to everything else. And that's true. But keep in mind that the P&I stands for principal and interest. So the interest part, that goes to the bank for their profit or their interest in the opportunity. So that goes away. You never see it again. But the principal is going to the bank for pay down of the mortgage. So as each monthly payment gets made, monthly or annually, that principal goes toward the mortgage balance. So you own a little bit more of the asset or of the building each month or each year away from the bank. So each month, each year, you just get a little bit more of the ownership or a little bit more equity is made available in the building or in the asset. Now, also keep in mind that, remember, you went to closing, or you and your fellow investor or investors went to closing with 25% of the acquisition price. In this example, you showed up to closing with $137,500. And the bank said, you know what, Mr. Investor, you know what, I'm going to show up to closing with $412,500. And all I want is 4.5%. So you bring your 25%, I'm going to cover the rest. And in return for that, you give me 4.5% and pay me the rest over the course of 300 months, or as we learn here, 25 years. And you walk away from closing. You walk away from closing with the keys to the building. And not only is it a building, it's an asset. So not only do you get the keys to the building, it's an asset. So you walk away with the ability to make a profit from the building too. That's amazing. Is that not amazing? You show up to closing with 25% or $137,000. The bank says, hey, I'll show up to closing with $412,000. I'll give you the property. I'll give you the keys to the property. You just give me 4.5% of profit and you keep the rest. Whatever else you can get out of the building in terms of profit, you keep all that's yours. That's crazy. That is the power of leverage when it comes to real estate. So that is something that we talked about in prior shows that is by far and large a benefit of real estate investing. You cannot do that with too many other investment vehicles in the world today. So I'm going to bring this show to a close, as we've got quite a few other expenses to talk about when it comes to the expense list or the expense category. We talked about principal and interest, and in the next show, we'll talk about the rest. And we're also going to talk about in the next show some key indicators or measurements that we look at when it comes to determining, is this real estate investment or this asset a deal, or is it not a deal? Hey, I hope you enjoyed the show. And I hope this show finds you and your family healthy and safe as coronavirus or COVID-19 cases start to surge around the world again, especially here in the U.S. where I am. As it relates to this show, I hope you found it helpful. I hope you found it beneficial and can take action from it. If you can, or if you are, let me know. I'd like to hear from you. And definitely share the show with someone else so they can find it beneficial and take action from it too. Don't keep it to yourself. If you didn't find the show helpful, or if there's something more that you want to hear in this show, or have a question that I can answer for you, reach out to me. I'll look forward to hearing from you. And I'll look forward to seeing you back here next time on the It's Attainable Real Estate Investing Show.
You have been listening to the It's Attainable Real Estate Investing Show, sharing transparent knowledge on investing and the powerful impact real estate investing can have on your wealth and lifestyle. Follow or subscribe to the show using your favorite podcast app so you'll know firsthand when a new show is released, or visit neelyrealty.com/podcast and see the show there. That's NILEE realty.com/podcast.